Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. Bitcoin and other cryptocurrencies are rarely out of the news, and these days, any conversation about money, the markets, and investing will almost certainly involve some discussion of this newest of financial markets. For a long time, the attitude of traders and investors about cryptocurrencies was pretty binary. Either you bought into the concept completely and were what we might call a crypto bug, or you were on the other side of the fence and were totally agnostic about the world of cryptos. Over the last 6 or 7 months, some of those who are anti-crypto have started to have a change of heart, as the two largest coins, Bitcoin and Ethereum, started to move further into the mainstream, and institutions began to move into the space. However, this last week has been amongst the most testing weeks ever for the cryptocurrency market, and may have caused many to reassess their approach and involvement completely. So, what happened and why, and where does that leave cryptocurrencies? First, some numbers. According to data from Bespoke Investment Group, in the 7 days between May 12th and May 19th, $1.37 trillion was wiped off of cryptocurrency market cap. That figure was almost twice the total market value of the cryptocurrency market at the start of 2021, which stood at $759 billion, but which rose to $2.58 trillion earlier in May. That valuation has now effectively halved. The poster boy for the space, Bitcoin, reached a high of $64,879 as recently as the 14th of April, and touched a low of $30,321 on the 19th of May. Professional traders talk about the stability of a market in terms of its volatility, or its propensity to make sharp price moves. And those who would assess risk in a market look at these price moves to determine how frequently they are likely to occur. They quantify the likelihood of occurrence in units of what's called standard deviations. Events that occur frequently have a distribution of 1 or 2 standard deviations from the mean, or average, and 95% of all events or price moves fall within these categories. The moves seen in Bitcoin and other cryptocurrencies in recent days have been of the order of 5 or 6 standard deviations. To put this into context, all else being equal, a 5 standard deviation event should occur once in every 13,932 years. Whilst a 6 standard deviation event or price move should occur no more than twice in 2 billion years. The almost insane level of volatility within cryptocurrencies will make them uninvestable for many mainstream investors, and even the most aggressive speculators will think twice about taking on that kind of risk profile. Just why have cryptocurrencies been so volatile? Well, there are a variety of reasons. Firstly, news flow. Last week, the People's Bank of China let it be known that it didn't consider cryptocurrencies to be an acceptable method of payment, whilst the U.S. IRS proposed that all transfers or transactions involving $10,000 worth of cryptocurrency or more should be reported to them by exchanges and brokers. Secondly, there is a fragmented market structure with numerous competing exchanges making prices in the coins. And thirdly, we have a wide disparity in the types of investors who own and invest in cryptocurrencies. For example, in Bitcoin, just 1,000 wallets control 40% of the coins, and just 100 of these wallets or accounts control 13% of all Bitcoins on issue. Yet, there are more than 100 million Bitcoin wallets or accounts in existence. So, we have a lopsided market structure made up of a few whales and millions of minnows. What's more, these larger accounts, or whales, tend to be the least active traders in the market, and if they do come into the market, they tend to emerge to buy more Bitcoin following a sharp dip. The other factor that contributes greatly to volatility in Bitcoin and other cryptocurrencies is leverage. Many smaller traders are not trading Bitcoin itself, but rather geared derivatives that are linked to the Bitcoin price. To trade these derivatives, traders put down a small deposit or margin, and that deposit is geared up or leveraged by the derivatives provider, allowing the end client to hold a far larger position than they could otherwise afford. However, as professional trader Gary Portugal said this week, many people had posted insufficient margin or collateral at Bitcoin exchanges and had their positions forcibly liquidated as the prices moved lower. He added that participating in cryptos via excess leverage is very different from participating by actually owning coins. Those doing the former, who in many cases could not afford to lose what they were risking, have taken a big hit. The combination of excess leverage and extreme volatility is a toxic one, and to some degree can create a self-feeding chain reaction. Whilst this might all seem to be contained within crypto markets, anecdotal evidence suggests that many smaller traders have invested their stimulus checks into Bitcoin and the like. And after last week's moves, that money will have simply evaporated for many leveraged traders. Stimulus checks were intended to stimulate the real economy and provide additional funds for those hardest hit by the pandemic and lockdowns. Will this unprecedented level of wealth destruction now have a knock-on effect on the real economy? Analysts at Deutsche Bank didn't pull any punches in a research note on cryptocurrencies published last week, saying that Bitcoin's valuation was almost entirely based on wishful thinking, adding that Bitcoin's sizable market capitalization makes it too important to ignore, though its volatility means the cryptocurrency's evolution into a widespread means of payment is unlikely. Bitcoin and other cryptocurrencies probably haven't bitten the dust, but investors should exercise caution when and if they deal in them, and should only do so with money they can afford to lose. That's all we have time for this week. Please make sure you do your own due diligence before making any investment decisions.